Welcome, everyone. We'll be kicking off our mid-year outlook in just one more minute. Give another 30 seconds or so to make sure everyone's able to hop on.
I just took off the screen share for a minute to welcome everybody who's here. So I think it's a good idea. We'll give it a little bit more time, as Michael said, but we'll get going here pretty shortly.
Welcome, everyone, to 360 Financial's 2025 Mid-Year Outlook webinar. If you recall, at the beginning of the year, we did a webinar titled Pragmatic Optimism. And this is a part 2, Pragmatic Optimism and Measured Expectations. We're delighted to have you join us today. We're going to be looking back at the beginning of 2025, reflect on some major themes that define markets, and explore what's ahead for the rest of the year. I'm Michael Urch, CFP professional, senior wealth advisor at 360 Financial. And we also have Mike Rogers and Brian Bohnsack joining today as we look at key economic trends, market dynamics, and strategies to help navigate the rest of the year with confidence. And so without further ado, let's get started.
Well, hi, everybody. Thanks for joining us. We are going to start this session with a little bio on each one of us. You can find us in our respective offices, but we're going to jump right into an economic outlook poll. And so, Cameron, let's launch this poll and see kind of where people are at right now. So, if you mind, just answer how you're feeling about the economy. Are you very optimistic? Are you somewhat? Are you neutral? Are you pessimistic? Or you're very pessimistic? As a reference, for the beginning of the year, as Michael talked about, we had about 40% were neutral, 40% were somewhat optimistic. Interesting going into 2025 with New Year's resolutions and that sort of thing. We weren't really seeing a huge impact of people feeling overly optimistic about the economy, but again, not pessimistic either.
All right, it looks like we've got results here. We have 7% are very optimistic, but most at somewhat optimistic, 47%. And then we've got 27% neutral, 13% somewhat pessimistic, and 7% very pessimistic. And so most is crowded in that somewhat optimistic, about half of the participants in that category.
Yeah, that's interesting. So I would guess a little takeaway is maybe we have a little more, and I apologize, I'm looking at two different screens here, but somewhat pessimistic is probably a larger percentage. It's a few people that kind of fall under that umbrella. But we'll talk a little bit about what's going on in the economy. Thanks for taking the poll. I think it's always interesting to gauge where our participants are with this. So with that, let's take a look at the economy. There's no doubt about it, the economy is kind of in this uncharted water scenario. And between all the things going on with tariff talks and of course, with the concern about inflation, concern about interest rates and how that might impact inflation, what's the business outlook going to look like? So this is a pretty big segment today that we're going to try to cover. And it's changed quite a bit from what we talked about back in January. Because at that time, if you recall, we just basically had, Trump administration was coming into office. We had not really a good idea of what sort of, timeline we might be looking at as far as policy changes are concerned. They came along fairly quickly. It impacted the market fairly quickly. So this meeting today, this presentation's got a lot of powerful information in it. So let's focus a little bit on the economy and kind of what we're seeing here. So what this chart is showing us is kind of GDP growth, and then simultaneously it is showing kind of a composite index with business orders. And so what you have here is, under the current economic landscape, it's kind of difficult to gauge, given all the distortions from different aspects of the economy, where we're at. And so we do have a decline in GDP in the first quarter following this surge that we had in imports. And so you see that over here on the right side of the screen, and that's referenced by these green bars. Of course, during recessions, if you go back in this chart to 2000, you'll see all the negative GDP quarters, and that denotes a recessionary environment. But then what we're also tracking on top of this is if from a rebound or from a perspective of looking at a strong recovery is what's this composite index make up of? And this is a economic condition which is kind of trying to manage insights into business views from across the country in both goods and service industries. And that also fell in some recent months. So we had some GDP slowdown, not negative, we didn't go into recession. And we had some insights as far as kind of polling, if you will, to try to get an idea from other service industries and manufacturing industries, kind of what their thoughts are. And it shouldn't be surprising that the composite index of the ISM decreases, because when you have, and we'll talk about this more, when you have a lot of uncertainty around whether, what's this tariff picture going to look like, it makes it a little bit harder for these companies and these CEOs to basically plan. So we're seeing a little bit of definitely a slowdown in GDP, definitely a slowdown in the composite index, and this data is pretty updated. It's as of the last month, so it's relatively new from the perspective of what we're looking at. This is something Brian talks about at every one of our investment committee meetings: interest rates and Fed fund rates is kind of what we're listing here. And Brian, I know there's another part in the bond part of the portfolio that we talk about this, but when you're looking at forecasting of a Fed cut, and obviously this would help the economy, generally speaking, that's the case. What are your thoughts here on this slide?
Yeah, right now the forecast, the Federal Reserve meets, about 10 times per year. They have a meeting later this month. And right now the forecast looks like no rate cut here in the July meeting. They take the month of August off, but then if you look down in September and beyond that, there is a very high probability that we will see a rate cut, in those months. So September, October, leading through the end of the year. Might be one, might be two is kind of the best guess, the best estimate right now. And that does impact, the interest rates in other parts of our economy, the longer rate bonds and mortgages and interest rates.
Mm-hmm.
So
yeah, so and how does this impact the economy? Obviously, the higher the interest rates are, the cost of doing business goes up because you've got debt obligations that you're probably paying on, and maybe they're at 7% versus 4% or 3%. It also impacts the consumer and what the consumer can borrow, from a housing standpoint, so.
Yeah, absolutely. When, interest rates are higher, people are not going to go out and finance a large purchase. If it's a car or even a home, they're going to sit on their hands. But if rates come down, they're going to get excited. Hey, it's time to go find that new car, maybe that new home, or refinance existing debt. And on the business side, then, a business owner can go out and maybe build a new building or bring in new equipment. And because he or she feels, hey, I can afford the debt service, it's at a lower interest rate. So it definitely does spark, the economy.
Yep. And that's kind of, we're not going to talk about it today, but that obviously has impacted the housing market too.
Yep.
Mortgage rates back here in this, when you look at these Fed fund rates, that brown line on your slide there, that's kind of, near zero, and mortgage rates are at 3%. We still have the same problem we had at the beginning of the year, and the same problem we had a year ago. And that's kind of in the housing market. We've got demand, which may or may not be slowing down a little bit, but the problem is in the secondary market, not the new construction market, there's just not enough inventory still because nobody wants to give up their 3% mortgage.
Yep, absolutely, Mike.
So, the other aspect of this is, the labor market and kind of what's going on in the economy and in the labor market. Market looks to be pretty stable, especially in the near term here. There might be some choppy waters ahead on the horizon, but when you look at this chart, what's interesting about it is the green columns are representing, from the left axis, is representing higher rates, and unemployment is pretty steady. It's right around this 4%-ish range as far as the unemployment. We're seeing a little tick up in layoffs, not very much, but we're seeing this huge drop in hires. In other words, they're not hiring additional people to join their companies. And we're also seeing this huge drop in the quit rates. So remember back in 2022 when we had the great resignation? Well, we're not seeing that anymore. People aren't job hopping like they used to. And this is pretty typical. When the labor market gets a little tighter and there's more uncertainty of what's going to happen with the economy, people are less likely to jump from job to job. And you know, the you know, the Fed's June beige book is what they call it. We saw all 12 Fed districts describe lower labor demand. But what's interesting about this is if you go back, lots of industries, lots of companies have said in the past, it's very hard to find talent. Okay.
Yep.
And so what might balance off this? Typically, if you go into a really slow economy and you maybe even a recession, which by the way, we're not calling for that, but if you go into a slower economy, you see unemployment tick up a lot. Okay. But I think a lot of companies are saying we need to keep the workers that we have. Instead of laying off a lot of people, what we might end up just doing is reducing their hours, reducing their overtime. Now some of that's tax free and to workers, and they want potentially some more of that overtime with the new tax law changes. But if you have difficulty finding talent and finding qualified workers, you're less likely to lay them off with the hopes that you could get them back. So it's probably what's going to play out here in the labor market, and that should be pretty good for the economy. So you don't see this huge uptick in unemployment, and we've never really gone into a recession when unemployment's stable. So any thoughts, Michael or Brian, on this quit rates versus higher rates slide?
Yeah, when I looked at this chart, I think it also means that, hey, employees are going to stick around and that drives efficiency. So that can drive more profitability because we all know that when we bring in new employees and it costs money to train them and get them up to speed. But if we can keep the employees working at their capacity, they're working, it just helps the bottom line, and that could drive, a little bit more profitability for some businesses.
Yeah. Yeah, and you combine that, again, we'll talk a little bit about it later, but you combine that with technology enhancements that we've seen, quote unquote AI, which is a real thing, is creating a lot of enhancements to the amount people can get done already, So, recession risk, this slide shouldn't surprise anybody, but if tariffs do go up, and they surpass this 20% rate that's been floated around. Now, I tell you, this changes every single day. So it's hard for us to even track it here. But if tariff rates surpass 20%, the chances of going into recession get higher. Cost of goods go up, prices go up, people slow down their purchasing, that snowballs into a slower economy, that snowballs into GDP shrinking. Hence, you end up in a recession. Okay. So this ongoing uncertainty around trade policy is a concern, and it's something that we want to keep an eye on. And I think it'll become a little bit more clear in the coming months how this is going to actually affect the overall recession. As long as businesses are able to find free trade zones, as long as they're able to find exclusions, and maybe some other loopholes to defer or minimize tariffs, we don't really see where trade policy is going to come in as a factor of raising recession odds. And by the way, a lot of this data that we're sharing with you today comes from our custodian partner, LPL Financial, and they've put together a lot of these slides. So I want to reference them as a source to a lot of this materials, but as an investment committee, as a group, we also review this and see if it makes sense with the things that we believe. And this makes sense. This just seems logical. The problem with tariffs, as we talked about earlier, it creates uncertainty. If you're the CEO of a company, big major company, and you're trying to decide, should we build a factory in the United States because we're going to have these tariffs that we have to to worry about. And that's really the goal of the administration, is to get more of that work here in the US. But then the next day, there might not be tariffs. It's very hard to plan around that. And so the business leaders are kind of in this situation where they're not exactly sure which direction to step. And maybe by taking no direction, that hurts their profit margins a little bit because they can't be proactive. They have to be reactive. So we'll see if that actually spills into companies' earnings. So far in the second quarter here, we're not seeing that being the case, but it'll be interesting to see if that plays out a little bit more. Okay. So that's it on the economy. GDP is low. Let's just summarize it here before we get to the poll. GDP is lower. 2% inflation is the number that the Fed is looking for. We're at 2.7, so we're not quite there yet. There's going to be some pressures for them. There's going to be some pressure on inflation rates probably, but we'll talk about that in a minute. But the economy is pretty good. Labor market is pretty good. Maybe even there's some argument that since a lot of this tariff talk has subsided and what that might look like, and I saw it in the Wall Street Journal just yesterday, they referenced the U.S. economy is getting its swagger back, whatever that means. We just don't picture right now, while there's a lot of uncertainty, like this huge recession and this huge need to be pessimistic about the U.S. economy. So as we move off of the economy and we move into the stock market, Brian, Michael, is there anything maybe that I missed?
I think we have some good graphics coming up, but talking a little bit more about the certain markets, what sectors are doing well, which sectors maybe are lagging. So that's kind of the key theme that we've been talking about.
One thing that I would say on the economy is that the U.S. economy has been amazingly resilient, even with a lot of sort of unexpected developments throughout the year, and that remains to be the case. And so that's really has been good news.
100% agree with you. The U.S. economy and the consumer are charging along, in lots of fronts. So that has been good. And capital expenditure at the corporate level has still been high. As a matter of fact, in some areas it's gone up. So, All right, so let's do this. Let's, Cameron, can we put up stock market poll number 2? Get some gauge of where people are at.
And while you're all thinking about your stock market prediction, I want to mention that we do have a spot to put in questions. If you have any questions, there's a little Q&A box probably around the bottom of your screen. Feel free to put those in, and we'll answer some as we come along and have a little dedicated time at the end for questions as well.
Good. Yeah, we like questions. It keeps it more interactive. That's why we have a panel here. We try to bring in different insights, different opinions. We all talk about it as an investment committee, but it gives you, frankly, it gives you somebody to hear except my voice all the time. And so we like questions because it continues that interactive aspect. And that's why we also added the polls. We want to hear your thoughts. So, Michael, are you seeing the poll results?
I'm seeing the poll results. Looks like over half say they think there could be some downturns, but it will recover. The next highest is I think stock prices will go up, followed by I expect little change, it'll stay about the same. And then the smallest response goes to I expect significant declines in stock prices. And so overall, more optimistic answers, I would say.
Yeah, and it looks like 57% people think there's going to be some downturns, but it will recover. So we had that this year, didn't we? We had it in April for sure. We'll talk about that in a second. And what's interesting, back in our January poll, 64% of people were in that category of thinking there'd be some downturns, but it will recover. So good for you, because the key to that is the recovery aspect and not losing faith. And so when we look at stocks going forward, let's take a look at kind of where is the path to upside, and is it, looking bright, or is it clouded with a little bit of uncertainty? And the great thing about the markets, the stock market specifically, is there's always some clouds with uncertainty. So what we have to do is kind of figure out what clouds are storm clouds and what clouds are going to pass, and do our best to look at the overall market conditions. And when the markets go down, see if there is a path for it to come back up like we've experienced in the past. Of course, I always have to throw in there, past performance is no guarantee of future results. And you all heard that from us. But it is a scenario that makes a lot of sense, that if you're a good long-term investor, these derailed markets tend to correct themselves. So here's a good example. And we were just going through this a little bit the other day, and we're looking at here the recovery process of when a market goes through a correction. Okay, so a correction is about 15% or more. It's not a bear market, it's a correction. So what we have here is going back to every correction that we've had since 1966, and we just chart how long did it take for it to get back to normal, if you will, get back to break even. And so it's a lot of data points on here. I know that's could be a little bit confusing, but if you can follow the dark blue line, that's where we're at in 2025. Okay, and it V's up. We saw this again during the COVID epidemic. That actually went down even more, so that's why it's not on this chart. But this is correction territory, and you can see that the stock market at the beginning of the year, I've got the data points on here, was about 6,000. It topped out at 6,100 at the beginning of the year, 6,150 on the S&P 500. That was in February. And then we had, the time period where the markets came down quite a bit. Part of that bottoming, this big drop by the dark blue line, was Liberation Day, and that was on the 8th of April. And the stock market dropped significantly that day. However, as Michael pointed out, if you just look at the chart, look at the upside. He pointed this out in a conversation we were having earlier. What happened to like the 10th of April, the 9th of April? Huge spike back up in the market returns, so a lot of volatility here in April. We all remember it. We sent out an email to everybody saying, hey, stick to our goal setting, stick to the process, and we'll see how this impacts everything going forward. But this does not impact our long-term goals. Stick with the program that we've built for you. And thankfully, I can say that there was not a single client that took their money out of the markets during this very turbulent time, very emotional time, and they stuck to what we put together for them for their goal setting form, life wealth plan agenda. Okay. What's interesting then is when the markets are kind of at their lowest and you get this big jump up in the markets one day, it gave some of that back throughout the month. But we have fully recovered where we were at the beginning of the year, and we fully recovered where we were about mid-February when the S&P 500 actually topped out. Okay. So data-wise, year to date, the S&P 500 is up about 7%. Okay. It's a heck of a roller coaster ride, but it has come back up. The other thing that's interesting about this chart is how long does it take to normalize to get back to break even? And you can see, nice visual here, very, very quickly. I mean, 1998 was a scenario where we jumped up quite a bit, but for the most part, in other corrected territories, the stock market has taken much longer to get back to break even. So this has truly been a V-shaped recovery. So, so from the April 8th Liberation Day announcement, the S&P 500 is up 26.45% from the low. Now, again, past performance is not any indication of future results or future normalization, but it does give you the reason to stay in long term. buy good quality investments, hold on to them. The economic impact out of DC is something that's going to be figured out later. But in the short term, the stock market was acting with urgency in April, and not getting wrapped up in that was crucial to be successful as an investor.
One of the things this slide reiterates for me is that you don't want to be a reactive investor, but to have a proactive investment process, because it would be very easy to react if you don't have a process in place or an investment policy like we have for our clients. And so, I mean, it really, to me, reinforces the value of that.
Yep. Yeah, I couldn't agree more, and if you don't have a process in place, then what ends up happening is you make emotional decisions that are reactive to a bad market. And so this slide here just shows kind of some correction dates and how long it takes to kind of get to a point of break even. And like I said, from where we were very bottom here, we have recovered, and we'll see where we go from here. And we'll talk about that next.
Yeah, and I mean, on the, if I could just comment on that table really briefly, if you're looking at the bottom right, it's just showing the average after recovery point. So the recovery day was June 26th for us. 6 months moving forward, historically speaking, the S&P 500's averaged about 9.6%, and 12 months later, 16.2%. Now, past performance doesn't indicate the future, but that just gives a little bit of context on what often happens post-correction.
Yes, yep, and it's and again, for the clients who stayed in it, and ours did, it turned out to be fruitful, because if you're not around to get these 6 month and 12-month upsides, then all you've potentially done is either missed the opportunity, that's kind of worst case scenario, or locked in those losses. Sometimes they go hand in hand when the markets have dropped. So good point. And like I said, we're up considerably from where we were. So let's take a look at kind of what's going on with the markets now that we've come back up. And as we know, typically the stock market follows earnings, right? So there's lots of volatility in between. But what really drives when you own companies is what's important is earnings. And what this slide shows is kind of how does big technology, the Magnificent Seven stocks, now we've all heard about this terminology, how does that impact and boost, in this case, the earnings for the S&P 500? So again, Magnificent Seven over on the left, that's Google or Alphabet. His parent name is called Amazon, Apple, Meta, the old Facebook name, Microsoft, NVIDIA is part of that, and Tesla. And so, a little bit of a mixed bag as far as how those stocks have performed, but that's the quote-unquote Magnificent Seven. And you can see the one reason the Magnificent Seven stocks did so well, especially the last couple of years, is look how well their earnings growth have performed. They're growing at a much higher rate than the S&P 500 was back in 2023. They didn't have to deal with as many supply chain issues as the manufacturer did. They didn't have to deal with inflation issues as much as other industries had to. So you're seeing this huge ramp up in earnings from those companies. And now what we're seeing is a slowdown of those earnings. They're still excellent, but we're seeing overall better earnings growth from the collective group of 500 companies instead of just 7 companies. So with that being in mind, though, is the Magnificent Seven, because of some of the technology advances they do have, are still growing at a quicker rate than the S&P 500. And now we're not telling people, oh, go buy the Magnificent Seven stocks. What we're just showing is, look at how this kind of impacts the earnings of the S&P 500 in general. The biggest positive surprise maybe last year's earnings season was 30% from these Magnificent Seven stocks. So they continue to do well. Technology continues to do well from an earnings perspective. Generally, over time, that should mean stocks would do well. And these companies, because their earnings are so good, comes back to the economic issue. Their earnings are good. That means they can spend more money, and they might even be expanding their capital expenditure, like somebody like Facebook is doing, who announced that they're going to actually increase their spending this year. And that helps offset slowdown of the economy. So it's pretty interesting when you start looking at these different valuations in these different charts. When we look at page 14, the stock valuations are definitely elevated. And so when you look at the Magnificent Seven, this is forward-looking price earnings ratio and past price earnings ratio. So it's the price of the stock over the earnings of the stock. That's what determines your price to earnings multiple. And so what you see here, the blue line is the PE for Magnificent Seven stocks. They're right around 30. They've been as high as almost 40, and they're currently around 30. Okay. If you look at the S&P 500 earnings, which is about 21 under the current market of a 6,300 valuation on the S&P 500, you can see that that's high on this shorter term chart, but it's also high versus longer term charts. Typically, the S&P 500 doesn't trade at 21 or 22 times earnings, and we'll have a chart that shows this in a second. What's very interesting is when you take the S&P 500 and you remove the Magnificent Seven stocks, you'll see again that the price to earnings ratio drops. And all that's telling you is that maybe there's some potential or some I don't want to use the word deals, but there's some values maybe that you could derive from areas that the market's kind of been ignoring recently. And that's on the value side of the stock market equation, the quality side of the stock market. And so the green line represents potentially some opportunity to invest into areas that aren't so expensive. And let me put that in perspective. The S&P 500 is up 7% for the year. The NASDAQ, which is more technology driven, heavier weighting in the Mag 7s, that's up about 8% for the year. Okay, the Dow Jones is only up 4%, and not even an S&P 500 index measurement, but the Russell 2000, which is a small stock index, is up 0.42%. And so again, the market has been kind of ignoring the smaller and mid-sized marketplace and really focused on this mega cap, specifically technology. Okay. That's been going on now for a couple of years. Brian, Michael, anything on there that maybe they would want to reference? I'm sorry, I jumped out of it.
Yeah, not on that slide. Could you go back to, there was a slide with a few different correction time periods. We had a question come in that I think had to do with that slide. It was a few back. And so a question just came in, what are the one before this one? What are the numbers across the bottom of this chart? And I just wanted to answer that question. So the 0 is the low point of that correction. And then the negative numbers going backwards are months prior, and then it's going 6 months forward. I just wanted to make sure to answer that for the participant that asked.
Great question. I did not cover that. So it's always good to know what's being measured there. Okay. So we've covered this. We've covered this as far as valuations are concerned. So where does this valuation story take us to? So what we're trying to gauge here a little bit is how much more room is there to the upside in the short term of stocks? Now, remember, again, we believe that if you own good quality companies, whether you own them in an exchange traded fund, you own individual stocks or in a traditional mutual fund, quality companies that can figure out and maneuver around tariffs, that can increase their earnings, are good long-term investments. So what we're trying to measure here is kind of on the short term. What does this look like? The S&P 500 is now at 6,300. Okay, so when you look at some proposed earnings for next year, at $275 from the S&P 500, and you take a 6,300 price point to that, what is basically bringing us in is a multiple of around, 20. What you're hoping for is that the stock market generates about 23 times earnings. Right now, we're trading at about 21 times earnings. Okay, so this S&P 500 target scenario creates this box of potential rate of returns, and there's two levers that can force the stock market to go up higher. Okay, as of the end of June, it's 21.4 on this price earnings ratio. One lever is earnings can be higher than expected. Okay. So if earnings continue to grow, because remember, that's the denominator in the PE ratio, then you can get higher valuations in the stock market. Okay. So right now, you could almost say that the stock market is kind of thinking that earnings are going to be about $285 next year, not $275, because the other way the markets can go up, so you can drive up earnings or you can drive up valuations. And so if you have a higher price to earnings ratio, then what you get are higher end results. So again, if you think that the stock market could go to 24 times earnings, which is very aggressive in the short run, that would be hard to believe, but I guess it could happen. And you kept the earnings at 275, that's telling you that the stock market valuation would be about 6,600. So about 300 points higher than it is today. So, the big thing here is, where are we at right now? Right now, we know we're at 6,300. That's not a cheap market. The market wasn't cheap at the beginning of the year either. Corporate earnings for the first quarter were solid. The second quarter was a little bit more of a guessing game, and we're still in the middle of earnings season because everybody was hedging their bets on the tariff aspect. But for the most part, earnings are coming out pretty strong. Bank earnings have come out and they're pretty strong. So if this 275 is low by kind of what's out there in the marketplace, that will be obviously good for our environment. But we know it's 6,300, and you look inside this box, we're in pretty much the territory where all of these numbers are kind of covered. In other words, in the short run here, I'm not sure how much further the stock market could go up just based on these valuations. Okay. So what's the wild card? Go ahead, Brian.
Yeah, that's a great point. I think the wild card is the bond market. If we start seeing rates come down, we're going to see dollars come out of the bond market and go back into the stock market. And also, we have a lot of cash still sitting on the sidelines. People are still very happy to earn their money market rates, that 4% range. But if we start seeing money market rates go from 4 down to 3 or less, they're going to get antsy, and they want to go do something else with that money. And it could go back into the stock market, and that could drive up demand, which will drive up PE ratios.
Yep. That's historically that's been the case, right? That's lower interest rates drive up PE ratios, and because the alternative of a 1% interest rate on your money is the stock market.
Yeah,
definitely. Yep. I think a couple other wild cards. So maybe we have 2 or 3 of them. One is AI. And how does that increase efficiencies of these companies to drive their earnings up faster than what we have projected here? Well, AI is real. It's going to take less time for AI to become mainstreamed than it did the internet. Back in 2000, you might recall everybody was talking about, the internet's going to change the world. And it did, but it took longer than expected, right? Remember all those .com stocks that went belly up because they didn't have a business model, but they were on the internet. Those companies have obviously gone away, but the internet did change the world. But it took 10 to 15 years, you could argue 20 years for that to occur. AI is going at a much quicker rate, and therefore is going to become more mainstream quicker. It could impact this earnings number better or sooner, you know. And then we had the tax law changes that just became permanent. Now, you know, the big beautiful bill, whether you like it or you hate it, what it ended up doing at the end of the day, as we analyzed it, is it took the tax cuts that were temporary back in 17 and made most of them just permanent. Okay. It also impacted the capital, excuse me, not the capital gains rate, the estate tax exclusions on the federal side. For a lot of our clients, this was welcome news because if the exemptions had dropped in half, that would have been a whole new set of planning around your estate planning strategy. And so that conversation does not have to occur unless, you know, again, you've outgrown the exclusion amount. But there are some advantages potentially to corporate America within this permanent statute of some of these some of these tax rule changes. So that could impact earnings. You know?
Yeah. Because $1 less of taxes is $1 of earnings. And then the corporation's got some nuggets in their research and development where they can now spend money on research and development and make that a tax deduction right away instead of amortizing that. And also on capital goods, they can now take an immediate write-off or accelerate amortization. So now businesses might be sitting back and say, hey, we can go out and spend some money because we know the tax savings are real and are going to be permanent. We don't have to think about this again, you know, next administration.
Yeah. So, you know, and that creates more certainty, and therefore businesses can, despite the tariff uncertainty, could go out and spend more money on things because they know what the immediate benefit would be from a tax code perspective.
Exactly. More planning, better planning.
You know, so what we'd hope for potentially in here is maybe we get a little push up in price to earnings ratios, you know, as far as the number. Maybe we get a little push up in earnings per share, you know, so you're in this 280, 285 range. You know, maybe you get to a valuation where the S&P 64.40, 65.50, you know, somewhere in that range. You know, and that's not a huge increase from where we're at right now. So, you know, I can't say we're pessimistic, but to see another 26% gain from the lows that we saw from April are probably not very realistic.
And of course, we're focused on the S&P 500 with this chart, but there are other opportunities outside of just the S&P 500 as well. And you know, diversifying is a big part of what we do for clients. So I want to mention that too.
Yeah, and that's a good point. That gets back to a little bit when I was talking about small cap stocks and small companies, mid-sized companies. They haven't kept up with this sort of expansion of the price to earnings ratio. So maybe there's some opportunities in there. There's also some potential opportunities in international that has not been there for a long time. So great point, Michael. This is really focusing on these large U.S. companies only. So might be pretty pivotal to start looking at other areas as well. No. How about we jump into bonds a little bit? We got a survey here, and Cameron, maybe you can tee this one up for people as we head into the fixed income market. Just to let you know, every time we have an investment committee meeting, Brian talks about certain areas of the bond market and what we're tracking. So he's going to reference that in this section for us today as well.
While we're waiting for the results to come in, fun fact about 360 Financial, our clients know this, but if you aren't a client, maybe you don't. This is our 30th anniversary this year. And so 30 years ago, Mike decided to break free of the broker-dealer world, start an independent firm. And here we are 30 years later. The mission we have is enriching lives. And I just want to give a shout out to Mike and to 360's celebration of the 30th year.
Thank you, Michael. It's hard to believe it's been 3 decades, you know, and you know, really focused the last 5 years, especially on building out processes, building out repeatable ways of working with our clients and kind of how we manage the relationship so that that experience is at the very top of what somebody would expect. But we've come a long way since I started literally in an office that was a closet. And I think they had to take the brooms out of it when I moved into it. and there was no windows because windows cost more. So I didn't want to pay extra rent. So yeah. How are we doing?
Looks like we got our results. Number one answer, it's okay, but I have some reservations, 64%. Second best is I'm neutral, 27% answered that. And third place, I'm worried about bonds and prefer other investments. And surprisingly, not only last place, but also no one said it. I think it's a great time to invest in bonds. I guess no one feels that it's a great time to invest in bonds at this time.
Yep, part of our survey. So it's not that far off from what we had at the beginning of the year. We had 44% neutral, with 33% saying it's okay with some reservations. It's I think what we've seen here on the neutral part is that actually has come down a little bit. And on the reservations part of it, part of it could be it's just we got to explain maybe better why we should own bonds in some portfolios. So it could be a communication piece because we think there's actually some pretty decent opportunities within bonds now. So let's take a look at this Jekyll and Hyde bond market because there's definitely this tug of war aspect between the economy and this deficit spending. So that's become a big deal, of course, and that was what a lot of people were talking about when it came time to pass this new tax bill. Is what's that going to do to the deficit? Before we get to the deficit aspect of it, and again, Brian, anytime you want to jump in, feel free to do so. But this is a chart. It's somewhat confusing, but it's basically just showing what's the relationship between a 10-year government bond and the 2-year government bill, and is there a positive or negative relationship in those numbers? So
yeah. So when we look at this graph or the slide, when we think about a 10-year bond versus a 2-year bond, you would think hey, I'm going to hold a bond for 10 years, I should get paid more, meaning I should collect more interest from the bond holder versus my 2-year. And that's kind of the logic. But right now, we're not getting paid very much extra to hold a longer term bond versus a shorter term bond. Right now, it's about a 0.5% difference. Historically, there's always a 1% difference, meaning a 10-year bond will give me a 1% more interest rate than a 2-year bond. And if you remember back late 23, there was no difference. In fact, sometimes the 2-year bonds are paying better than the 10-year bonds. So right now we're creeping our way back to more of a normal range of that, what we call a spread, but we're not there yet. And the shorter end or the shorter term bonds are still being paid very nicely, and people are very happy to sit there and collect their coupon or collect their interest rates and not be tied up for a very long time frame. So that's kind of what this graph is showing us today.
Mm-hmm. Yeah, it's a very good recap of this. And so, I think it's interesting to look at the perspective that the 10-year bond right now is paying 4.34%. And back to the deficit issue, we do have this large deficit. You might say, well, how's that going to impact our bond market? The one thing that's interesting, except for the UK, if you kind of go around globally, if you look at Italian bonds, Spain bonds, German bonds, their 10-year rates are actually lower than ours.
Yep.
So we're already paying the world an inflated interest rate to buy our bonds. And so you might say, well, is that going to continue? It could, but don't forget we also control the world currency with the dollar. That could change too. We don't think that's any time in the horizon. But with the 10-year at 4.34, at the beginning of this year, it's 4.6. So we're seeing it come down slightly.
Mm-hmm.
Then let's see here. I mean, a year ago, almost at this time, it was 3.6. So it went from 3.6 up to about 4.6, and now it's starting to trend back downward. Anything, Brian, that clients should take out of that scenario? We're actually a little bit higher in rates than we were a year ago.
As we mentioned earlier about the Federal Reserve cutting rates, that will have a direct correlation, not tied directly, but a very high correlation between what the Federal Reserve is doing on the short-term interest rates and what the 10-year looks like. So we do expect the 10-year to come down later in this half of the year because the the forecast is that the Federal Reserve will cut rates 1 or 2 times, 25 basis points, 20, quarter point, maybe 2 times between now and the end of the year. So, and then it's, because again, the Federal Reserve has kind of 2 mandates, which is a good slide here is, full employment and low inflation. We're there on the employment side, as we mentioned earlier. The employment is very low and still continue to stay low. There's some creeping up a little bit, but not very much. But inflation is still out there, and it's and that is what they're trying to fight by keeping interest rates a little bit higher, elevated. Now, inflation has come down. We're seeing some relief, both at the gas station and in the grocery store and other things. But there's other parts of our economy we still see very high inflation and costs going up year over year. So there's a little bit of and I think that's why the author of the slide said that Jekyll, Dr. Hyde, and kind of the tug and pull between those two, forces. So,
yeah. So if and again, that's kind of something I've mentioned in the past. Be careful what you wish for. What you really want are low interest rates.
Yeah.
What's going to spark that environment? It's probably because the labor market has come down quite a bit. Therefore, unemployment's gone up. It's probably because the economy is slowing down quite a bit, and the Federal Reserve is trying to jumpstart the economy. So right now, the Federal Reserve is saying inflation is still not at 2%, and we're not sure what it's going to look like post-tariff, and so we're not really doing anything. Now we've all seen the political battle that's kind of going on too, between the current administration and Powell, and who's going to blink first, so to speak. But as of right now, I think what we're forecasting is what's pretty similar out there is that you get a couple of potential rate cuts on the short end of the curve, and maybe get more steepening of the curve. In other words, the 10-year doesn't come down nearly as much as the 2-year, and that might mean that there's some opportunities to kind of stay in that shorter end of the curve to make some money going forward in bonds. You also have less volatility in the shorter end of the curve, not money market short end, but just 2 to 7 year duration probably is probably about the max you'd want to go on your bond areas based on what we're talking about. Make sense?
Yep. And I think, you mentioned earlier the worldview, the United States bonds are priced at a higher rate than, like you said, you mentioned most developed countries, and that's out of sync. And that's what's probably frustrating, economists and other people are saying, hey, we want interest rates to be lower so we can compete, evenly or fairly with other bond issuers across the world.
Yeah, absolutely. And what we want to have is, if we're going to still be the economic power that we are, we actually don't want interest rates, at 0 or 1%. No. Look at when we did have that happen. COVID, Great Recession, so, it's a scenario where there's room for them to come down, but a drastic decrease in interest rates would actually imply that the markets have changed quite a bit.
Yeah. And as a bond investor, high interest means high income. And so it really is a good environment to be an investor in bonds.
Yeah, you get better returns. Now remember, again, we're not trying to predict the stock market, especially on a short-term basis, but the stock market is kind of valued at the levels that it is versus where it could go based on PE and based on earnings. Maybe there's some opportunities in this bond area. And so what we do is we try to match up a client's risk tolerance, what sort of volatility is acceptable to them versus their asset allocation. But right now there could be some pretty good opportunities in bonds. The other area we haven't talked about, because we live in Minnesota, most of the people on this webinar are from Minnesota. Maybe they don't live here permanently still, but they're originated from here most likely. We pay a lot of taxes here. And so municipal bonds, tax-free interest. And if you buy Minnesota bonds, they're tax-free from state and federal taxes. Might be an opportunity for clients that are in a higher tax bracket. They've struggled a little bit earlier this year for a couple of different reasons. We just had a meeting with one of the money managers of a municipal bond fund that we use. And part of it was just some drop in demand because people weren't sure how they were going to be taxed with the new tax bill. That's gone away. And then increase in supply because of the same reasons. We saw muni bonds not perform very well, especially the first 4 months of this year. But they do look like a pretty good opportunity. Talk to your advisor about them if it's something that you want to learn more about. Okay, one other thing as we close up here, just currencies. This is impacted by the the deficit and everything else, but the dollar has dropped in value. I was fortunate to be in Europe here recently. My son was married in Ireland, and the euro is more expensive than the dollar, and it's about an 85% to 1 equilibrium in that area. And this chart shows that the dollar has had a pretty significant drop this year, and and so I've got a couple of data points on it. I want to make sure that I've got these right. But the dollar has dropped about 8% for the year, which is pretty significant. And this dollar index has not dropped 8% in the quarter's time period in the past. And this thing has been out there tracking since 1973. It actually is 8.4% drop. You might be like, Mike, Brian, Michael, why do I care about what the dollar is? I'm not going to Europe. Okay, but this does impact a little bit the international part of our portfolios. We've been light international for years. That's been the right decision because the dollar had been strong. When the dollar is really strong for lots of variable reasons, that's usually harder for international stocks to do well. The weaker dollar, now we're actually seeing international outperform for the first time in a long time the U.S. stock market. Now, is that a long-term trend that will continue? We'll see. But it is interesting that the weaker dollar is translating into better returns. And part of it is with all the tariff talk, with all the different things going on, there's this kind of flight to home for a lot of these dollars. And so people are like, where's my money going to get treated the best, if you will? And that might be just in their home country. And so we're seeing this pickup in the international markets. And so we're watching that pretty closely as well, because currently we're still underweight that area. And then we'll see if the technology out of China, for example, with this DeepSeek model, which is an AI program to compete with GPT, is real or not. But it's going to be interesting to watch how this all develops.
Mm-hmm.
Okay. So I think we've covered everything that I think we wanted to. We've covered the economy. We've covered the stock market. We've covered the bond market. We've taken a few questions. Any other questions out there that we have not answered yet, Michael?
One question that I hear regularly is how to plan for inflation with a retirement portfolio. And so if you want to just answer that, that'd be fantastic.
Yeah, it's a great question, and it comes up all the time. And I've been saying it for years and years, probably decades actually. Inflation is your number one enemy when you're retired. And you think about it, because you can't go make more money to offset the cost of goods going up on you. And I was just talking to my mother-in-law about this, believe it or not, on Sunday. We're out at her house visiting her. It's like everything is going up. And I said, in price. And I said, yeah, that's exactly the problem when you're retired, quote unquote, fixed income. You have to be able to combat these inflationary trends. 2.7 is not runaway inflation, 2.7% inflation rate, but still impacts. And as Michael said earlier, we've seen food prices go up a lot more. Eggs are coming back down. That was a big hot topic for a little while. Eggs have started to come back down to a normal range. But you've got to plan around inflation. And this last couple of years has really reinforced why that's so important, when frankly, most people forgot kind of all about it because inflation was so low for so long. So put into the plan, run some projections, make sure you're looking at preserving your buying power when we're running these scenarios. We do that on a regular basis. If you're not working with us, make sure that whoever you're working with is running these projections that take that in consideration. Does that answer the question?
Yeah, it's great.
Good. All right, so we're at the top of the hour. Of course, any other questions you have, reach out to us. Call your advisor that you're working with. We got a whole team of advisors. We got a group of people that will help you here. I have to show these disclosures that just talk about risk, and investing, of course, incurs risk. And forward-looking statements are just projections. There are no, guarantees those forecasts are going to come true. And then there's other general risk disclosures. We didn't get into a lot of the risk versus return on credit quality in bonds, but there's areas where municipal bonds are subject to availability and change of price. I talked a little bit about that, so make sure you understand bonds well before you invest in those, because of course there are risks there. And any of the projections that we're making incurs some assumptions that may or may not play out. Okay. I think now would just be a good time for me to jump into a little bit about what 360 does, because I know we have a number of people that are not clients that are on this webinar. So welcome. And I thought, then again, Michael and Brian, just jump in with your input, but I thought, because we've been talking about investments, stocks, bonds, the economy, maybe I'll just talk about our investment process. And it's a good reminder or refresh course for our current clients that have been with us for maybe decades. But for everybody who's new, let me give you an overview of how this investment process works. First of all, we manage all of our clients' money in-house. We don't ship it out to some third party that we don't have any say in how those portfolios are built or what sort of changes they're making. We do it inside. This is your investment committee meeting, your participants. We get together on a regular basis, at least every 2 weeks, more often when we have volatility in the markets. We look at things like Brian has been talking about, interest rates and bonds. We look at our bond investments. We compare those to other bond investments. We look at our portfolio of equities and we make some comparisons to that. So collectively, over 200 years of experience sitting in on this committee, going through our clients' investment portfolios to make regular investment decisions. And that could be changes, or it could be we just stay put. But that's what's driving and who is driving this process for you. Okay. And what does the process look like? Well, we have this approach. First of all, we build an asset allocation based on the risk tolerance that we think is acceptable for the client. Okay, and we have some innovation and some technology that we use to help us gauge that as best we can. And then we build a portfolio that meets that asset allocation, meets that risk tolerance. And that portfolio is going to include stocks and potentially bonds, depending on what sort of investment mix is appropriate. But it's built on this foundational approach. We believe in good quality dividend-paying stocks make up the bulk of the stock part of the portfolio. These tend to be U.S. companies. They tend to pay dividends. They tend to increase their dividends. Remember inflation we talked about earlier? If you can get inflation, if you can get dividends that go up faster than inflation, now you're starting to get ahead of the game of this inflation problem that's that worst enemy for you when you're in retirement. Because sooner or later, you might start spending those dividends. You might just accumulate them in the accumulation phase, but in the retirement phase, you're going to actually probably start using them for potentially for part of your income. Okay. This foundational approach also takes us to these dominating companies, the innovative companies. Could be some alternatives. We have, for example, right now, some kind of natural gas line stocks in the portfolio. And then at the bottom, here represented by a small fraction of the foundation, is the fixed income piece. The more conservative we're at with the portfolio, the more the fixed income percentage grows, but what we're trying to do in this very well diversified portfolio is make sure that we have our bases covered. Okay. And we typically use low-cost exchange-traded funds to drive most of this investment foundation. layered on top of this, and this is one thing that makes us unique, is we're looking into what's going on with leadership. And so we have 36 different sectors that we score for how strong are those sectors performing from a stock market valuation compared to the overall market. And our goal here is to try to make sure that you have some money reflected in those strong industries or strong sectors, so that we can try to make some money within the portfolio. And so as we go through this score-based analysis every other week, there's 19 separate scores that we're configuring and that we're tracking. And a lot of times we might move money from one, not a lot of times, when we move money, it might just be from one industry, one sector to another sector or industry that's doing better. Okay. The goal is to try to have some of this money, and it could be anywhere, depending on the asset allocation, it can be anywhere from about 8%, 9% of a portfolio up to 20% of a portfolio, again, depending on the risk nature of the account. So, guys, is there anything that I might have left out as far as this design feature to our portfolio management that would be helpful for new potential clients?
Yeah, I think we're looking for those sectors that are surging or momentum. So we know that the economy doesn't, or this market doesn't move in sync. You know, there's certain sectors that are in favor, out of favor, and that's what those, you know, that's what we're trying to represent in our leadership sectors.
Mm-hmm. And currently, you know, we have money in infrastructure. We have money in, and that came into the portfolio back when Biden signed $1 trillion infrastructure bill, the IRA bill, which included a lot of infrastructure. You know, so there's a lot of growth in those companies that were building out the infrastructure in this company, and therefore the stock prices have done well, you know. We have internet stocks in there. We have energy represented for the most part in this natural gas area. And then we have capital markets, which is kind of, for the most part, investment firms, brokerage firms, and insurance companies. You know, it's kind of a couple of different areas. And that can be pretty robust, where the foundation is really more of a rebalancing approach or asset allocation approach. The leadership area, the momentum area changes a little bit quicker. Now, does that mean we're trading the portfolio every single time we get together? Of course not. What it does mean is what we're monitoring it and managing it for our clients. You know, and really what it comes back to is the investment piece just drives into what we really do here. What we really drive here is a planning process. We call it the Life Wealth Plan. And we drive this process based on 4 elements of what we think is important to most of our clients. And we try to figure out what's most important to you as a client. And it's almost always around these 4 topics. It's around family, it's around your occupation goals, it's around your recreation goals, you know, and what we want to make sure is that we're addressing why. Why are we doing all this planning? What's the outcome that we hope for that will give you an enriched life? Okay. The money is our how. And in our acronym of FORM, we never lose sight of the goals being family, occupation, and recreation. And then the money drives our ability to have options when it comes to the goals around what we do with our family, what we do as an occupation, i.e., when can I retire, and what are my recreation goals. Okay. And at the same time, when money acts as the conduit to it all, what we need to also focus on is what we can control. And this was our message back in April when the markets were going through a lot of turmoil. Okay, we can't control what's coming out of Congress. We can't control what's coming out of the White House. We can't control inflation. But what we can control is kind of our emotions around investing, our philosophy of this long-term perspective, good quality companies, our planning around let's set goals and make sure through our discovery, design, and deploy process that we are making sure to stay on top of what's important to you. And where these two very big areas intersect is what we call our life wealth plan. So the investments fit in as part of our life wealth plan because they drive what matters to you and some of those outcomes. But it's not the end all be all. What the end all be all is, let's focus on form goals. And we talk about this every week when we get together as a team. What are some of the form updates that we have for our clients? And how can we reflect those back into the planning topics that we go through with our clients on a quarterly basis? So our clients generally have one or two in-person meetings. Could be Zoom, could be at the office. But what we definitely have is a process that matches up with what I call the wealth management table. And there's 4 legs to that table. And what we do is we break that down into quarterly conversations where we address each aspect of that table and how it might change. Right now, for example, tax planning is pretty big. It really kind of comes into consideration more in the fourth quarter. But with the tax law changes going on, is there anything that I need to be aware of? Okay. And so you can see here what we have is a process of quarterly topics that should cover all spectrums of wealth management. And our process for the people who are new to us starts really quickly with, really easily with a fit meeting. Does the level of service that we provide and the fees that we charge, which are very competitive, but do they make sense for you? Okay. So, and if they do, then we seem to be aligned with your goals and what we do here, then that's what we discuss at the fit meeting. And if that makes sense, then we go to what's called the Get Organized meeting, where we start grabbing your tax returns, Social Security benefits, other statements from other investment institutions, and start getting that organized so that we can start setting the goals that we're trying to accomplish in the implementation and the set in motion phase of the process. And then because we meet on a regular basis and we have quarterly conversations on a regular basis and we email you on a regular basis, we're constantly reviewing and aligning your goals to the strategy and to the process. So it's pretty cool. It's very dynamic and robust. And what we hope for is this team of tax professionals, investment professionals, service professionals can help you reach your financial goals. Seems simple. We've been doing it for 3 decades. We know it's a lot of work, but if we work together in tandem, we typically see some pretty good outcomes. So anything that I would want to address that maybe I missed for people who are new to us, I just encourage you to schedule a 15-minute conversation, or you can spend a little more time with a senior wealth manager and you can discuss how this might be a benefit to you. Brian, Michael, anything in?
No. And for the clients that are on the call, we also have our sounding board process. For anybody that's important in your life, they're important to us too. So we would love to sit down and have a conversation if they have some questions or if they need some answers. We're here for them as well.
Yeah, that's a fantastic. Thank you for bringing that up. The sounding board process is definitely something that makes us unique, and that is, if there's, like Brian said, people that just want some questions answered, they don't have to become clients. As a matter of fact, they might not be a good fit for what we do, but we're here to help them. And the way we look at it is, you're a member of our little club. If you want other people that can benefit from this membership, we're happy to help them along a little.
Yep.
So, Michael, anything in closing?
We're in the business of helping people, just like you said. And so, always happy to have more opportunities to do so.
Yeah, absolutely. Absolutely. Well, thank you for joining us. Hopefully you found this information helpful. Talk to your senior wealth manager and with other questions that you have. We look forward to the second half of this year. We will see you in January for our 2026 outlook, which is hard to believe. But until then, let's stay in touch and thank you for being client.